This is the Dynamis Podcast, where we give you the strategies and mindset to take control of your life and achieve financial and philosophical freedom. As David Geffen says, we are each the figment of our own imagination, and some people have a greater ability to imagine than others. This is part 3 of a 3-part mini-series detailing actionable steps to become a real estate millionaire. In this episode, you're going to learn how to structure contracts, how to lower your monthly payments, what to do if you have a pile of student loan debt and feel like there's no way out of it, and many, many more details that everybody's wondering about and just never asks. We're going to talk about skipping the bank entirely and focusing on a little bit of seller financing. So don't miss that. Stick around till the end of this episode. My name is Tim Garul, and I'm an entrepreneur on the journey of seeking freedom. I've lost everything for standing up for my beliefs, and now I'm building passive income so I never have to compromise my values for a paycheck. This podcast is your roadmap to earn your own autonomy. So if you want to remove your limiting beliefs, unlock a fruitful life, and truly become free, join me and let's get to the next level together. Welcome in, guys, for part 3 in the series. If you missed parts 1 and 2, I would encourage you to go back and listen. It just sets a really firm foundation for wrapping up for really what this entire series is focused on. So I would encourage you start with episode 80. That's where I go over part 1. I explain how to leverage bank debt in easy, actionable steps to get started. We're going to talk about inflation, loan paydown, appreciation, and why bank debt is so powerful when you're just getting started. Part 2, episode number 82, is a start to finish guide for the entire process of purchasing a residential property. We covered terminology, timelines, how to find and assemble your team, literally everything. And today in part 3, we're going to bust some common myths and misconceptions. We're going to answer common questions that I get from people DMing me on social media. And we're going to talk strategy. We're going to talk about interest rates, fun things like seller financing. The goal for the completion of this 3-part miniseries is that you leave with everything that you need to start your journey of becoming a real estate millionaire. And look, maybe you don't want to become a real estate millionaire. Maybe you're just trying to buy your first house. That's fine. This has everything you need, but I would encourage you to dig a little deeper and really try to open your mind up to how real estate can supplement a wealth building retirement plan for when that time comes. I think that the evidence is just undeniably present that those who own assets that float on top of inflation as we get closer to retirement tend to do better off. And the more of those inflation floating assets that we have, the more comfortable we can become in the later years of life. Real estate is a long-term game. There are people who can force appreciation and pull some cash flow out really quickly. But keep in mind, real estate is a long-term game. We are being patient, savvy, prudent investors that are being disciplined today so that we can enjoy the fruits of our labor later. So let's kick this thing off. So just a quick reminder to everybody listening to the show, I am a real estate investor, but I'm also a mortgage lender, and I do these types of things for a living. And if you want a private one-on-one strategy session where I help you get started because you don't know where to start, the show has its own text line. And I want you to text the word strategy to 833-455-4368. That's 833-455-4368. And while we're at it, if you are local in the Pacific Northwest, I host an investor meetup. It's completely free called Tacoma Pints and Properties. And we meet on the first Tuesday of the month. And it's just a collection of people who want to get to the next level together. We're leveraging each other's knowledge and our network, and we're learning how to grow and build our real estate portfolios. It's an awesome room. If you have never done a single deal, you belong in that room. And if you are doing thousands of deals, you belong in that room. It is for everybody. You're going to walk away with something beneficial, I promise you. If you want to get on the list to be notified of when we're meeting and who's speaking, I bring in awesome keynote speakers. Same text line, 833-455-4368. Text the keyword pints. And lastly, if you are wanting to get started or struggling to find deals, well, oftentimes access to the opportunity is the limiting factor for many people. And I would encourage you to text the word deals, the keyword deals, DEALS, to the text line 833-455-4368. And I put you on my deals list. Those are private lists for the audience only, that when I have an opportunity that comes up and I like to share that with my community, you'll be the first one to be notified to take a look at that, and we can all participate and grow together. All right. So today we're going to start the episode off by going through systematically questions that I get from listeners who DM me cold. And we're just going to explain them incrementally, one by one. And we're going to go through all of these things together. And hopefully by the end of part 3 today, you'll have the premise, why we're doing what we're doing. You'll have the action steps of what to expect and how to do it. And we will wrap up today with just common questions that everybody wonders about, but never asks for some reason. And I think that the most successful people in life are those that are not afraid to ask those questions. The faster that you can gain that access, the more successful you're going to be. So before we get started, I want to just give a nod to all of you people out there who are sitting on the sidelines and feeling stuck in inaction. You're feeling bad for yourselves because you haven't got started. I'm going to speak largely to my generation, which are the millennials who are like, hey man, I'm approaching middle age. I'm in my 30s and 40s and I haven't bought home yet. And I just want to encourage you, don't let that be a limiting factor to you. You can start any time, and you would be amazed if you just put your head down and continue to grow and compound. You look up 5 years from now, you're in a totally different position in life. Okay. But it has to start with the first step. So stop looking in the rearview mirror, stop feeling bad for yourselves. Stop having this perspective of I'm never going to do it, and start taking action. Okay. We need to look through the front windshield, not the rearview mirror. Change your perspective. There's opportunity out there. So this is for you. You can absolutely get started, and it starts with the first step. So get going. So question number 1, I get from a lot of listeners. I get a lot of people on social media DMing me, and they want to know, hey, Tim, we've heard about these hacks where you make extra principal payments towards your loan. So a loan is broken down into 2 parts. When a bank gives you a loan, you have interest and you have principal pay down. Okay. So every month a portion of your payment goes towards interest and a portion goes towards principal. So I always say when you pay your mortgage, it's like having a forced savings account. And what that means is a part of that payment goes directly to you. You are paying down the loan amount on your property. So it's kind of like a forced savings plan. The other portion is interest, and the interest is front loaded in a loan. So you're going to pay the most interest on the first 7 years of your loan. And so there are these hacks. They're very popular, especially on social media, where people talk about, hey, make some extra principal payments and you're going to pay off your loan quicker. And that is absolutely true. And if you are looking for an easy, free resource, a tool to try to figure out, okay, well, exactly how much money am I going to save and how soon am I going to pay off my loan? If you go to our friend Dave Ramsey, I know there are mixed feelings on Dave Ramsey. I personally really like Dave Ramsey up until what I call level 1 wealth. So you need Dave Ramsey to get out of debt, to get your house in order, to get savings. But where I differ from Dave Ramsey is it is okay to use healthy debt, good debt, to leverage appreciating assets and grow your wealth. Okay. So go to Dave Ramsey's website, and he has a loan pay down tool, and you can figure out, hey, if I make X amount of extra payment, how much is it going to save me and how much faster will I pay off my loan? I'm just going to give you a quick example, a really easy one here. So let's say that you have a house that's $375,000, or that's the loan amount. So your bank loan is $375,000. You got an interest rate of about 6.25%, which I think is very feasible in today's market. That would make your principal and interest payment $2,309. And if we just added $191 to that payment, meaning we round it up, so our total monthly payment is $2,500 each month, we're making an extra payment of $191 towards principal. What ends up happening is you cut off 5 years of your mortgage term. So if it's a 30-year term, you're cutting off 5 years. So you're going to pay that thing off in 25 years, and you're going to save in interest $91,802. Guys, that's not a small number. That's not a number to brush off. That absolutely works. It's real. And you can figure out, well, how much can I afford to pay down towards that? Now, I think there's times to do that, and there's times to not do that. If you have assets that, tenants are paying off, it's a set it and forget it. It's for retirement. You don't necessarily need to pay down the principal faster, especially if you have really good low fixed debt. A lot of people that got interest rates in the 3s and 4s, hold on to that debt. If you don't need the equity in the property, just let the tenants pay that sucker down let the life of that loan ride out. But if it's a primary residence, yes, absolutely. You want to save on interest. Interest is expensive. And if you can round up your monthly payment and cut some of that off, you should absolutely do so. So that's probably the first question that I get. That's the most common. The second most common question I get from people reaching out is about student loans. Okay. I know that there are a ton of people with student loan debt. And I don't just mean like, 50,000 in student loans. I'm talking hundreds of thousands of student loan debt. Okay. And it's easy to see why student loan debt has become so prominent. Oftentimes people feel like they are unable to buy a home because they're buried in all the student loan debt. How can I get qualified? I'm going to take a quick second to stand on my stump here and just shout that, of course, people are buried in student loan debt because the government incentivizes it. They essentially say, hey, go to college for any reason at all. It doesn't matter. And we're going to guarantee you that we're going to give you financing for your debt. And what happens is that these institutions, these universities, they're for profit organizations. They're not nonprofits. They're not charities. And when they say, hey, the government says, hey, we're going to pay for your debt. Well, to them, it's like a blank check. They're like, awesome. Well, if they're paying the bill, we might as well jack up the prices. So why not increase tuition every single year and make it to where you have to buy a new book every single year, even though the curriculum's the exact same? So I feel bad for a lot of people that got stuck in all the student loan debt. Fortunately, I really leveraged my GI Bill from my active military service, but a lot of people didn't have that option. And so we grew up in a generation where they're like, go to college for everybody. Everybody should go to college, which I disagree with. But I'm getting down a rabbit hole. Let's talk about student loan debt. So when you have hundreds of thousands of dollars in student loan debt, it's easy to feel like, well, there's no way I could even qualify. Okay. The truth is that's absolutely not true. Oftentimes lenders can waive certain types of debt or overlook them, or at least only hit you with a percentage or a fraction of that debt. Medical bills is a really good example. So if you have a lot of medical bills, oftentimes that will not be negatively counted against you. It depends on the status of these bills, but student loan is another one, right? So we can hit you with actually, instead of calculating your debt off of the full amount of these student loans, we can hit you with a fraction of a percent of the overall debt. And that's the only thing that will be counted against your, what we call your debt to income ratio. So oftentimes people are much more able to qualify than they think. And even with loans that are deferred, a lot of times people will call and they're like, hey, I don't have any student loan debt because it's all deferred. Well, yes, technically you're not making payments on it, but you're still on the hook for all that student loan debt. So we have to calculate what your payment would be based upon that fraction of a percent. Now, there are different guidelines for different loan programs, but typically we can hit you with between 0.5% to 1% of the total debt amount. So if you're, for example, $120,000 in student debt, what we would do is multiply 120,000 by 0.5%. And your monthly payment on that debt would only be $600. So when we're looking at what your debt to income ratio is, and we're trying to qualify you on purchasing a home, we're going to hit you with what we call a liability for that debt of $600 a month. So there you go. $120,000 of student loan debt turns into a $600 a month payment that we're going to hit you with. And we're going to move forward, take your gross income and continue to qualify you for a loan. So just because you have a ton of student loan debt, which most people have, by the way, don't feel bad. Most people have a tremendous amount of student loan debt. There's absolutely a path forward regardless. So don't be bashful. The best thing that you could do is reach out, schedule a strategy call, and we'll go over it together. The worst thing that you can do is just think that you have no options and bury your head in the sand, because even if it's not possible right now today, we just make a plan and get you there in the future. Okay. So make a plan, take action, and get where you want to go. All right. Here is question number 3 that is very popular right now, which you could imagine as to why. People want to know what the heck is happening with mortgage interest rates. And I'm sure I'm not alone. I'm sure you shared in my sentiment as our jaws collectively dropped last year when we saw interest rates creep over 8%. I had an investor client who bought an investment property and had an interest rate north of 9%. And the deal still made sense to him and he bought it. Guys, that is nothing to bat an eye out. I know that we have a lot of people who have been in real estate for a long time. And they're like, I don't know what you guys are complaining about. Interest rates were 15%, 17% when I got in the game. Fair. Okay. That is fair. But what we are seeing is a incredibly steep increase in housing, the cost of housing, insurance, asset prices individually. And what we have not seen is an equal pace to keep up with wages. And what that does is it makes housing more expensive, especially for first-time buyers today. If you have a ton of equity in your home built up over the years, yeah, it doesn't make as big of a difference to you because you're just going to exchange or sell your property and put the equity or the principal that you paid off into the new home, and your payment stays relatively the same. I might go up a little bit with the interest rates right now, but it's a big deal. And so when we're looking at when is a good time to buy a house, what's going to happen with interest rates, we need to really be analytical and forward looking. We need to look at the market, what's happening, what's coming ahead, what's on the horizon, but also what has happened historically. Okay. And just because things have historically happened doesn't mean that they're going to happen again, but it gives us pretty good indicators of what to expect. By and large, there's really nothing new. Albeit COVID was not in the bingo board for 2019 to 2020. However, now we have a pandemic and we can price that into the market in the future and use that as, okay, here's what we did wrong. Here's what we can expect. And the same can be said when we have really rapidly increasing inflation, or we have one of the steepest interest rate increases in history. And so as we're looking ahead, I think it's really important to preface that nobody for sure knows what's going to happen. Even the best economists in the world, the most intelligent people, the people that are on the news channels and podcasts who are the global leading economists, even the Fed, they really cannot predict what lays ahead. However, we can aggregate a collection of data and make pretty decent predictions on what lays ahead. And according to the aggregate metadata, Freddie Mac, for example, has come out and stated that they think that the average 30-year fixed is going to settle around the low sixes by the end of this year. Right now, they're saying that it should be between 6.6 to 7. I just looked at pricing yesterday for a 30-year fixed loan. It's about 7.11%. So we are seeing rates come down, but there's a lot of things at play here that are making the mortgage market volatile. Okay. One of those things is inflation. So if we have high rates of inflation, that's really bad for mortgage rates. As we have high inflation, the cost of goods is really high. The Fed wants to make the cost of money more expensive to de-incentivize people from spending it so rapidly. So one of the ways that they do that is they make the cost of money more expensive by increasing interest rates, which slows the exchange of money for goods, right? Which makes money more valuable. It retains its value over time. The Fed is really good about stating what they are going to do. And they have this thing called the dot plot, and they have Fed meetings and they come out with their minute. The minutes are like the breakdown afterwards, and they give statements about what to expect on the horizon. They have said that, yeah, they are looking for an opportunity to start cutting rates. Initially, we thought it was going to be in the first quarter of this year, potentially February, March, maybe. The market started pricing it in. We got some hotter inflation reports, meaning inflation came in higher than was expected, and the market reacted adversely. And so we're just floating around in this gridlock of higher interest rates. The Fed has come out and said, we're really looking for job losses. So they want it if there's a really important metric to look at right now, it's the labor market. And when the labor market starts to break, meaning we have a higher rate of unemployment, I think you can expect to see interest rate cuts coming. I don't know how many cuts. There's a lot of predictions between 2 and 3 cuts by the end of this year. Who knows? Maybe not. I think at the end of the day, if you're buying a house for shelter and you can afford the payment, and you're getting a good deal on the house, buy the house if you can afford it, because interest rates are temporary, right? Don't speculate on interest rates coming down. Make sure that it makes sense for you today, but don't get too hung up on interest rates, especially if it's a necessity. If you need a place to live, it's for shelter. We are seeing strong appreciation in the market. Houses are continuing to appreciate at like 5% a year by average. So don't get too hung up on the interest rate. We are in a market shift right now, but I do believe it is going to get better. All right. Can you cancel a real estate contract? This is another one I get. Yes, you can. you can cancel a real estate contract. You want to protect yourself. So a real estate contract is a legally binding agreement, meaning you could be liable for damages if you decide that you want to buy a house and then you do not follow through with your obligations per the contract and you walk away. You could be susceptible. So you're absolutely able to cancel a contract. You're going to want to make sure you put things in there called contingencies. And contingencies are just ways to protect you and your money against damages. You could have a contingency for things like financing. We talked about this in episode 2, financing, inspection, a multitude of things, right? One thing that you are going to want to put in the contract is that if you do cancel the contract for any reason, the only money that you would be forfeiting is your earnest money deposit. That way you're not liable for further litigation or damages. And if you're wondering what damages you could be liable for, go back and listen to episode 2. I don't want to get down a rabbit hole in this episode, but I explain why it could be not ideal for the seller if you kick some tires and walk away from the contract outside of a acceptable reason, like we said, appraisal, inspection, or financing. Okay. Let's talk about paying points. People often ask me about paying points. And I would also caution you that when you are pricing a loan, if you're calling a lender and just asking what are interest rates, a lot of lenders are telling you an interest rate that comes with points and they're not disclosing that on the phone. And the reason is because they are in the business of sales and they want to get you in your funnel. They want to get you in their funnel. And by the time you're deep down the rabbit hole, you don't want to do additional paperwork to switch to another lender. And so they've got you. And it turns out, lo and behold, that the rate that they've been promising you is actually a rate that you have to purchase points with to get a better deal. And that costs thousands of dollars. So essentially, when you buy points on an interest rate, you're buying a lower interest rate. Now, we can talk strategy on this. I could do a whole episode on strategy of paying points, but there's 2 types of buy downs. Okay. You could do a permanent buy down and a temporary buy down. A temporary buy down expires. It usually adjusts every year. So a temporary buy down could be something like a 2-1 buy down, meaning if interest rates are 5% today, your first payment year, you'd have 3% because it's 2% cheaper. Your next year would jump up to 1% cheaper. So you go from 3% to 4% to 5% at year 3. Okay. It's a temporary buy down, meaning the discount expires over time and you end up with your full mature note rate or your terminal note. Okay. Then we have a tool called a permanent buy down, and a permanent buy down, they're a little more expensive but they're forever. Okay. And your money doesn't go as far. So when you purchase points on an interest rate, you're purchasing them permanently down. Now we have to look at portions of the market cycle to know when to implement those tools. I would encourage you not to buy a permanent interest rate down at the top of a market cycle, because we are probably going to see lower interest rates in the future and you're going to just refinance into a lower interest rate for free. And you would have spent all that money on buying down your interest rate and it would have been wasted, because when the market readjusts, those lower interest rates are just going to be there for you to grab on a rate term refinance. So I would caution against a permanent buy down when interest rates are at their most expensive. Where I do think a permanent buy down is really advantageous is when we're at the bottom of the interest rate market, meaning I don't think interest rates are going to get cheaper for the foreseeable future. And you really want to have a cheaper payment. Let's look at buying those points down. And a way to do that is you look at the total cost of how much the interest rate buy down is. So you look at, okay, let's just say it costs $6,000 to buy the interest rate down. All right. And then what you want to do is you want to compare how much are you saving each month in comparison to if you did not buy an interest rate down, right? If you didn't pay any points. So let's say you paid $6,000 a month, and in comparison to what we call the par rate, the free interest rate, where you're paying no points, maybe you're saving $150 a month. Okay. So what we do is we take that $6,000 of the cost and we divide it by the $150 a month in savings, and you figure out what that number comes out to. And that number for this example is 40. Okay. So $150 a month in savings divided into the $6,000 cost. And that means that in 40 months, you're going to break even for the cost of the point buy down. Now, what we have to do is look ahead at the market and ask ourselves, hey, do we think that we're going to have an opportunity to refinance to a lower interest rate than what we purchased in a 40-month period? And the reason you want to do that is because if you think you're going to refinance in 12 months, but it's going to take you 40 months to break even, it's a total waste of money. And you want to be really calculated. You want to think about that before you buy points. Is it worth it based on the market environment we're in today? If you have a lender who is just trying to give you a rate with points and they're not giving you comparisons or market predictions or leveraging their expertise, I'm going to tell you right now, you're working with the wrong person. You should be getting breakdowns. You should be seeing charts that are explaining to you your monthly savings, the total break-even time, and whether or not it's advantageous to you. So just make sure if you do buy points that it makes sense to buy the points. If you permanently buy your rate down, do it for payment purposes and preferably at the lowest of the interest rate market. If you're at the top of the interest rate market, really try to do something like a temporary buy down. It's cheaper and hopefully puts you in a position to be able to refinance to a lower interest rate in the future. Okay. A lot of people reach out to me and they ask me about, hey, Tim, should I buy a new home? Should I buy an existing home? I think it's really up to you what you want to buy. What I will tell you is that builders are very incentivized to come get your money, right? Typically, when you have a legacy home, something that has a pre-existing owner, you typically get things that are good and bad. You get a little more wear, right? So sometimes maybe you need to spruce up the carpet and the tile in the bathrooms. However, you get things like mature landscape, fencing is in the property. The neighborhood is settled and you get a feel for it. You understand the area and the neighborhood. New builds it's a coin flip, right? It's just a hodgepodge of people moving in there. You have really no idea what the neighborhood is going to turn into. Oftentimes, new builds have settling foundations with cracks and pops, and they have to come back out and fix these things for a number of years for the foreseeable future. It oftentimes doesn't come with landscaping, which could cost, I don't know, $30,000, $50,000 in sprinklers and grass and fencing. A lot of people get duped into the upgrades. You go into a model home on a new build and it's just magnificent. It's immaculate. And next thing you start adding on all of these costs to these upgrades and you are spending way more than you intended to spend on a home. I think new builds are wonderful. I'm not opposed to them. I would even buy a new build. I just think that a lot of people don't understand all of the hidden costs associated with them. So do your homework, do your due diligence, and don't get sucked into the emotional draw of every upgrade you could find and then not leaving enough budget for things like landscaping or a fence if you want to have dogs. So new builds are fine. Just do your homework. Okay, let's talk about saving 20%. This is a very contentious one. I get a lot of argument in the DMs, saving 20%. So I think that saving 20% for a down payment can be wonderful. Again, I could do a whole episode on this alone. We're just going to go through this one really quickly. I think if you're a homeowner and you have the money on hand to put 20% down, and it's not going to sink the boat, meaning you don't have a depletion of reserves. You have enough money for a rainy day fund. You can still go take your wife on date night or whatever it is. Yeah, it's not a bad idea to put 20% down. And the reason that you want to put 20% down is for a couple of purposes. It's your primary residence. Number one is your payment's going to be lower. Okay. When you have less of a principal loan amount, your monthly payment is cheaper. You're also going to save on interest overall because the loan amount is smaller. So you're getting charged less interest because it's a smaller loan amount. The big one for me is really mortgage insurance. So mortgage insurance, the bank makes you buy a mortgage insurance policy to cover their investment when you have less than 20% equity in the property. So if you put 5% down, okay, until you get 20% equity, they're going to make you carry a mortgage insurance policy. Now, these policies, you can refi off or request them to come off when you have enough equity. But oftentimes the fine print in them is that it's years before you're able to do this. How they appraise the home it becomes a little complex. And so it's an insurance policy that you never get the money back on. You're just paying mortgage insurance every single month that you will never recoup. It's to protect the bank's asset in the event that you foreclose. They have to sell at auction. They come up short because they sold your house at auction. It doesn't have the equity to recoup their investment. So they require you to pay for an insurance policy to make up that difference. Okay. Now, I don't like mortgage insurance. I think as a homeowner, man, that sucks to pay mortgage insurance, and I would do my darndest to not pay it. Now, there have been, I can think of 2 times where actually only one time where I've put 20% down on my own personal residence as a primary. And that is because I have not intended to make that primary residence into a rental property. Excuse me. Okay. Typically, if I buy a house, my plan is to live in it, house hack it, move out of it, turn it into a rental property. And I just keep stacking single family properties that way. It's a little uncomfortable, but you know what? It's how you build a portfolio over a period of time without really any fluff or frill. Okay. So I typically don't put 20% down because I know that my math, I've done that. I've underwritten these properties to when I move out, the tenant, the rents in the area, it's going to cover the debt service, meaning my mortgage payment. That also includes the mortgage insurance. If it doesn't pencil on the front end, yeah, you might need to put more money down. In one property, my primary residence, I put 20% down because I did not intend to put a tenant in it. I wanted the payment lower. I did not want to pay mortgage insurance. And I thought, you know what? This could be a forever home. So we're going to go ahead and put the 20% down. By and large, most people, by the time they save 20% to put down, the market is you got to understand the market's appreciating in some years very rapidly. On average, it's about a 3% year over year appreciation. But in some markets, we're saying 5%, 6% year over year appreciation. And if you're saving $500 a month and it takes you 5 years to save that 20% down, your home's appreciating faster than you can save up that 20%. And you would have been better off just getting in there with 5% down or 3.5% down and riding the appreciation up. Because as the asset becomes worth more money, that money belongs to you and you're benefiting from that appreciation. If you're sitting on the sidelines and saving $500 a month and it takes you 5 years, 10 years, you're losing out on all that appreciation. You're also losing out on the benefit of D because the rate of your savings is not outpacing the appreciation that you would have been benefiting from that house. So if it's going to be a rental property, you're going to move out of it. You can afford the payment, pencils. I don't know. It's up to you what you guys want to do. I personally try to leverage as much as I can. And I don't want to put more cash down because I want that cash to be available and liquid for me to put into other opportunities that are going to give me a return. That's my personal opinion. Dave Ramsey would fall out of his chair. This is where I say I'm a Dave Ramsey hybrid guy. I like Dave Ramsey for level 1. And then I like leverage past that. I think there's a time for having more and less leverage. That's my personal opinion. Like I said, I get people fighting over this in my comments all the time, but that's just that's my take on it. Okay. How do we lower our monthly mortgage payment right now? This is a big one. A lot of people, they are used to refinancing because rates were just dropping. It would lower their monthly payment, start their payment timeline back over to 30 years or 15 years. Everybody's happy as a clam. But what has happened is we've seen such an increase in interest rates. That's not an option anymore. Oftentimes, let's say you have some equity, you've had your loan for 5 years. And by the way, most people refinance their home every 3 to 7 years. That's the average, just so you're aware. You refinance that home, you've got 5, 7 years of equity in it. And so your balance stays the same. You're just doing what's called a rate and term refi. You're not taking any cash out. It restarts your payment timeline to another 30 years, drops your monthly payment, and everybody's good to go. Their payment's lower. Everybody's happy. Well, right now, because we've had such an increase in interest rates, if you refinance from a 3% to a 7%, you're not saving money. It's costing you more money. And so a lot of people don't really know what to do, how to save money on their monthly mortgage payment. And it's tough. It's tough right now. There is one option. I've talked about this. I made a reel on social media about it. It's called recasting your loan. So this is a kind of a little known hack that you can use to reduce your monthly mortgage payment without having to totally refinance. So how this works is essentially, if you send in a large additional payment towards principal, your balance would go down, your loan amount would go down, but the payment would stay the exact same. Okay. So we talked about earlier of like, hey, can we save time? Can we shave interest and time off of our loan by making principal payments? You can. By the way, you want to make sure that additional payment is very clearly spelled out to go towards principal. Okay. Make sure your bank is aware it's going towards principal, but it doesn't necessarily lower your monthly mortgage payment. So if you want the payment to go down, what you need to do is you need to call customer service with whoever is servicing your loan. And you want to request what's called a recast. And when you do this, make sure that the large additional payment, they're going to calculate your loan based on the new lower balance. So the term of your loan stays the same essentially, but now you have a lower monthly payment. So a lot of people, it's not something a lot of people talk about, but it's definitely an option right now. If you have a chunk of change sitting around and you really just want your payment to be lower, can't afford a refinance, just doesn't make sense right now, try giving a recast a shot. Call the bank up and see if they can work with you. That leads us to everybody's favorite thing that they want to talk about, which is seller financing, keeping the bank off market. Now, I will tell you that we are going to do a very thorough, in-depth, step-by-step walkthrough of seller financing, and it will be a later episode. I could probably devote an entire mini series in and of itself to seller financing. So we're just going to touch on it today. I'm going to go over some high-level things that you should consider when thinking about seller financing. I will tell you, we're going to do a much deeper dive in the future. So look out for a much deeper dive in the future. There's just so many intricacies. And you know what? My limited knowledge of seller financing has just come through my own experience, through seeking out seller financing opportunities. And oftentimes it comes from just building a network, from having friends who know you, like you, and trust you. And it's advantageous for them to be the bank, and it's advantageous for you to go through them instead of a bank. The key to seller financing is, and I cannot stress this enough, it must be win. Okay. You are solving a seller's problem. You are solving your own problem, and you're giving both parties a mutually beneficial agreement. You have to think about this, right? If the seller wants to seller finance, he has to put himself in a position that makes it more advantageous to go through him or her than the bank, right? Conversely, you have to show good faith to the seller and have something that can make them feel safe and protected, because they're taking on some amount of risk by being the bank and not having you go get a formal loan. Now, you can do seller financing for a lot of reasons. Number one, it just may be cheaper, makes more sense. You can negotiate creative financing, but you could be in a position where maybe you're a high income earner, but you write everything off on your tax returns. Maybe you switched jobs. Maybe, who knows, maybe you had some adverse credit issue and it's going to take you a couple of years to build that back up, but you have sufficient assets and your income is decent enough to where the seller feels comfortable making you a deal so that their liability, their risk is mitigated and they feel safe and secure and you're getting what you want. So again, I cannot stress to you, seller financing really comes from relationships. This whole business is relationships. So build relationships with people that are doing what you want to do and express to them what you're looking for. Tell them what you want. Okay. And once that is out there, the opportunity is going to come knocking at your door. When the opportunity knocks at your door, it's your obligation then to start tearing a deal apart and seeing, hey, can you give the seller what they want without compromising your rules, your non-negotiables? And if you can find a mutually agreeable thing or terms, then let's go for it. And here's just some of the things to consider. Okay. When you do a seller financing deal, okay, you're skipping the bank. So some things don't matter as much. Your credit score doesn't really matter as much. Your gross income kind of matters, but really they're going to structure the deal. Someone's going to structure their deal in a way that they are protected. Why would somebody seller finance to you? You might be asking. Well, let's say that they're at retirement age and they don't want to pay capital gains tax and they don't want to manage the property anymore. They could collect a check from you, the owner, just like they were from their tenants who are renting the property, except now they don't have the headache of managing the building. They're not paying a management fee. If something breaks, you're responsible for fixing it, and they're collecting interest on it. So let's say they sell the building for $500,000, they put a 5% interest rate on it. They're going to make more money on the term of that loan because they've got their sales price and now they're making interest on the remaining debt amount. So it's really advantageous to them. And you as a buyer can come up with some really creative ideas for the deal to work for you. You can do things like adjust the term of the loan. So for example, instead of having, let's say, a 30-year term, you could have a 40-year term with a 30-year balloon or a 15-year balloon. You could do interest only payments. You could do a balloon in 3 years with interest only on a 40-year amortization. You can negotiate interest rates. You could negotiate down payment, maybe no down payment, maybe very little down payment. Maybe the seller wants $100,000, but he's willing to carry the loan on a 50-year term at a 2% interest rate. And so when you realize there's a few levers, right? There's rate, there's term, there's price, there is down payment, And you can adjust those levers accordingly to get the seller what he wants, to make the deal make sense for you. Maybe cash flow is really important to you. Okay. And you want reserves on hand to improve the building. In lieu of a down payment, you could say, listen, I'm going to improve the property by $200,000. I'm going to do all these renovations. And if I default, well, you're protected because you're just going to re-inherit the asset in a better position than I bought it from you, and everybody's happy. But here's the thing. I need to cash flow up front. So I'm going to make you interest-only payments for 3 years. And then I'm going to put a 3-year balloon on it because when I'm done renovating, I'm going to go get a bank loan and cash you out. You have to understand that real estate is horse trading. We just get put in these boxes. We get trained into, we must do these things based on these forms, based on what the bank says. Anyways, those are the most common questions that I get from people reaching out to me on social media. And I think just a perfect way to end this 3-part series. Guys, I do this to help you get started. I get a lot of people who just don't know where to start, what questions to even ask. And this is a way for me to just give back and hopefully put a little bit of momentum under your walking shoes to get pointed and walking in the right direction. As always, I'm always available to you guys. Like I said earlier, I dropped the text line. If you have any additional questions, please reach out to me. I love helping you get started. And I love being on this journey together with you. So like I said, text the show anytime, 833-455-4368. I hope this 3-part mini series was helpful. If you like this, we'll keep doing things like this, and we'll just go into all the different topics, what I'm learning, what I've got my fingers in, and I will download my knowledge to you. So anyways, guys, thank you for listening and for being such an awesome audience. I love doing things with you guys. I love when you reach out. I love when you bring me opportunities. I love growing together. So let's keep it going. Thank you guys for listening, and we will catch you on the flip side. See you next week.